Welcome to vTalkInsight, Allocator's Lens Daily for January 9th, 2026. Cross-asset positioning is getting trickier as a previously strong risk rally meets rising geopolitical tension, ambitious earnings forecasts, and long-term yields that refuse to fall. Let's start with equities, where the push and pull between broadening leadership and fragile sentiment is most visible today. In equities, the backdrop is a tug-of-war between a broadening rally and a fresh bout of caution. Asian and European benchmarks have rolled over, and United States futures point lower, signaling a risk-off tone even as implied volatility, measured by common indices, remains subdued in the mid-teens. That mix of softer price action and still calm volatility suggests investors are nervous about upcoming data and politics, but have not yet fully paid up for downside protection. Under the surface, the equity story is still very earnings-driven. Consensus expects double-digit profit growth, roughly 11 to 15% over the next couple of years, with a heavy contribution from large technology and AI-related franchises. There is some optimism that earnings for names like Microsoft and Apple can beat these already high bars, helped by AI adoption, productivity gains, and guidance for solid revenue growth into the year-end quarter. At the same time, several voices warn that price-to-earnings multiples are more likely to compress than expand from here, given how much of the good news is already priced in. Defensive sectors such as staples and utilities even screen expensive relative to their own history, while parts of mega-cap tech look less stretched but remain vulnerable to any disappointment. Market leadership has clearly rotated. Small caps have outpaced large-cap technology, with some small-cap indices beating major growth benchmarks by several percentage points in early trading this year, and equal-weighted indices in 9 of 11 sectors hitting new highs. Financials and industrials have retained gains even as speculative pockets corrected, helped by expectations for a steeper yield curve, passive deregulation, and a backlog of capital markets activity. Defense stocks are another standout. Proposals to lift the United States defense budget by roughly half have triggered sharp rallies across American, European, and Asian contractors on the view that rising geopolitical tension will anchor elevated military spending. However, that theme is not without risk, as congressional resistance and new rules tying executive pay and shareholder returns to performance could cap valuations even as revenues grow. Geographically, dispersion is widening. Emerging markets with controlled inflation and solid growth, including segments of China where fiscal support is targeting technology and exporters, are seen as increasingly attractive relative to parts of Europe where recent equity gains owe more to multiple expansion than to earnings delivery. European earnings forecasts have already been cut from low double digits to low single digits, and discretionary consumer names across the region, especially in the United Kingdom, are struggling under broad-based consumer weakness and tax increases. Policy risk is another fault line. In the United States, populist pushback against stock buybacks and corporate ownership of housing is weighing on some large banks and alternative managers, while proposals to restrict institutional purchases of single-family homes and to channel mortgage support via agencies have injected volatility into home builders and real estate-linked equities. Alongside these cyclical and policy swings, structural growth stories remain powerful. AI and semiconductors stand out, with strong results from firms like Samsung, continued optimism on NVIDIA, and progress in onshoring advanced chip production at Intel, all reinforcing the narrative that AI infrastructure and data centers are a dominant capital expenditure theme. Productivity data, showing nearly 5% year-on-year gains with falling unit labor costs, bolsters the case that this investment can support margins rather than erode them. Healthcare innovation is another pocket of optimism, with gene and cell therapies moving toward mainstream adoption and expectations for increased mergers, acquisitions, and initial public offerings of biotech. But idiosyncratic risks are rising. Apple faces geopolitical exposure to China. United States autos are booking large charges on electric vehicle strategies that are being scaled back, and United Kingdom retail names are issuing profit warnings. For allocators, That leaves the equity market looking broader and more cyclical than a year ago, yet highly dependent on earnings delivery and policy clarity. The key watch points are upcoming earnings seasons, decisions on defense and housing legislation, and how quickly any shift in labor data feeds back into rate expectations. Moving to rates, the central theme is a supportive liquidity backdrop colliding with stubbornly high long-term yields. The Federal Reserve has already stepped in to calm funding markets by resuming asset purchases, removing an immediate tail risk for equities and credit. Policymakers appear broadly comfortable holding the policy rate steady unless data deteriorates sharply. Yet there is a vocal dovish camp arguing that current settings are too restrictive. One governor is openly calling for around 150 basis points of cuts this year, pointing to underlying inflation that looks close to target once lagged shelter components and technical factors are stripped out. On the other side, several arguments are keeping the 10-year yield anchored in the 4 to 4.5% range. Sticky inflation, especially if shelter disinflation falters, prospective tariff changes that could add roughly 0.75 of a percentage point to price levels, and worries about large fiscal deficits and central bank credibility all support elevated term premia. Despite widespread expectations for rate cuts, long-term yields remain high not only in the United States, but also globally, suggesting that monetary easing is not translating cleanly into lower borrowing costs. Against that backdrop, some see limited room for very aggressive cuts, especially with credit spreads, asset valuations, and household delinquencies not yet signaling acute stress. The labor picture adds nuance. Weekly jobless claims remain historically low, yet there are signs of a gradual cooling, and some expect unemployment to drift higher in the coming quarters. Because official employment data lag turning points, the Fed retains flexibility to ease preemptively if disinflation continues, particularly as productivity improves. In Europe, inflation is trending toward the central bank target, reinforcing a soft landing narrative and room for policy normalization. For multi-asset portfolios, the combination of ample liquidity, debated neutral rates, and high long-term yields means rate markets are a central transmission channel. Any surprise on shelter inflation, tariffs, or new fiscal packages, such as defense and housing initiatives, could quickly reprice curves and feed back into equity valuations and credit conditions. Credit markets remain remarkably calm on the surface. Spreads in both investment-grade and high yield are hovering near historically tight levels, even as net issuance in the United States alone is projected in the $800 billion to $1 trillion range this year. Globally, governments and corporations have already sold well over $250 billion of bonds in the opening weeks, and the market has absorbed that supply far more smoothly than during bouts of volatility seen last autumn. For some asset managers, that combination of tight spreads and heavy supply at this stage in the cycle means compensation for taking corporate risk looks thin, especially if growth slows later in the year. Beneath the calm in public markets, private credit is flashing more ambiguous signals. A prominent manager has allowed unusually large withdrawals from a flagship fund after elevated redemption requests, highlighting how liquidity promises can be tested even in vehicles built around locked-up capital. Headline default rates for private loans still look low, but limited transparency makes it hard to gauge true underlying stress, and regulators are stepping up scrutiny of potential systemic risks as retail participation increases. At the same time, substantial capital is targeting fast-growing areas, such as AI-related borrowers, raising concerns that competition for deals may erode underwriting standards and sow the seeds of future losses. The evolving situation in Venezuela illustrates both opportunity and complexity in distressed sovereign credit. The removal of the previous regime and the prospect of a United States-backed restructuring plan have led investors to sharply reassess downside risk, with some bonds reportedly moving from around 20 cents on the dollar to above 40. Yet the path forward is far from straightforward, given outstanding claims from expropriated assets, large obligations to state-backed creditors in China and Russia, and the hundreds of billions of dollars in investment needed to restore the oil sector. More broadly, the rapid growth of alternatives, with assets expected to exceed $18 trillion in coming years, and the shift away from traditional 60-40 portfolios suggests that private and hybrid credit structures will play a growing role in funding such transitions, even as public markets remain tight and well bid. In foreign exchange, the notable feature is that the United States dollar is not behaving like a classic safe haven despite rising geopolitical risk. A softer dollar is giving breathing room to emerging market assets, which look more attractive as long as this pattern persists. Interest rate differentials are driving preferences for currencies, such as the Australian dollar and Swedish krona, against both the dollar and the euro, reflecting relatively stronger domestic fundamentals and different policy trajectories. Overlaying this is a steady push by global investors to diversify away from United States assets, driven by concerns over policy direction, fiscal sustainability, and a perception that United States exceptionalism is fading. Digital assets are now firmly part of that cross-border capital flow story. A leading global exchange reports more than 300 million users and has secured a high-profile license in the Middle East, while launching regulated products linked to assets such as gold and silver. Another major platform is expanding beyond core crypto, trading into equity options, exchange-traded products, and tokenization services, aiming to sit at the center of real-world asset tokenization. However, regulators are also focused on the darker side. Illicit crypto activity jumped to well over $100 billion last year, with stablecoins accounting for the vast majority of transactions linked to sanctions evasion and similar uses. That tension between mainstream adoption and enforcement risk is likely to remain a key driver of volatility across both currencies and digital assets. Commodities round out the picture, starting with energy. Oil prices in the mid-$50 to around $60 range are being described as broadly deflationary and supportive for global growth, easing pressure on consumers and helping central banks in their disinflation efforts. Yet the supply and demand signals are mixed. Markets talk about a large surplus, but prices have not collapsed, suggesting either that demand is stronger than many forecasts implied, or that supply is being constrained by factors such as unsold Russian cargoes and disruptions in shadow shipping fleets. Spare capacity within producer groups is now concentrated in only a few members and is close to exhausted, limiting the ability to offset new shocks. The evolving policy toward Venezuela adds another layer of uncertainty. United States plans to control Venezuelan crude exports and hold sale proceeds in accounts it manages could redirect flows toward United States refiners and away from Asia, while keeping a lid on how quickly production can scale. Rebuilding the country's oil infrastructure to materially higher output is expected to take years and tens of billions of dollars, in a context of unresolved legal claims, high break-even costs, and hesitant foreign capital. In contrast, the long-term outlook for industrial metals, particularly copper, is decidedly tighter. Forecasts point to copper demand rising by roughly 50% by 2040, driven by electrification, defense, and especially AI-related data centers, whose share of United States power consumption is projected to rise from around 4% to the mid-teens by the end of this decade, with mine development often delayed by regulatory hurdles for well over a decade. That sets up a persistent supply deficit narrative. Precious metals are sending a different signal. Gold and silver, along with their miners, have already posted strong gains, enough that some investors are taking profits, and major exchanges have raised margin requirements on silver to cool speculative activity. Interestingly, gold's correlation with equities has turned positive in recent months, which reduces its effectiveness as a hedge, just as some strategists are turning more constructive on the sector on expectations of further central bank easing. Tokenized forms of gold and silver on regulated digital platforms are broadening access and blurring the line between commodities and currencies. For allocators, that means metals prices now reflect not just traditional risk aversion, but also AI and energy transition demand on the industrial side, and evolving views on monetary policy and portfolio hedging on the precious side. Pulling it all together, cross-asset markets are navigating a delicate balance. Equities still enjoy powerful earnings and AI-driven tailwinds with broader participation from small caps, financials, and defense, yet valuations are full and policy shocks around geopolitics, housing, and buybacks are increasingly relevant. Rates markets combine ample liquidity and talk of cuts with long-term yields held up by inflation uncertainty and heavy fiscal needs, while credit shows very tight spreads and record issuance alongside early signs of private market strain. A softer dollar and growing use of digital assets are supporting emerging markets for now, and commodities offer both disinflationary help from relatively cheap oil and structurally bullish signals from copper and related materials, even as gold's hedge role looks less reliable. Allocators may want to watch how upcoming data, central bank decisions, and geopolitical developments, from Venezuela to broader great power tensions, shift this balance across assets. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.